Hello and welcome to another episode of 10 Questions with Reunion. My name is Andy Moon, and I'm the co-founder and CEO of Reunion, the leading marketplace for clean energy tax credits. We work closely with corporate finance teams to purchase high-quality tax credits from solar, wind, and other clean energy projects. Today's guest is Hilary Lefko, who needs no introduction to practitioners of renewable energy finance. Hilary is a partner at Norton Rose Fulbright in Washington, D.C., and has significant transactional experience with Section 45 production tax credits, Section 48 investment tax credits, and is now spending a lot of time advising clients on tax credit transfers via the Inflation Reduction Act. Hilary, great to have you here today.
Yeah, nice to be here. Thanks for having me.
Awesome. So specific to Section 6418 tax credit transfers, what kind of deals are you seeing? I mean, what's the smallest transaction you've worked on and what's the largest?
So we're seeing all kinds of transactions. What I think is super interesting is, Congress's whole reason behind transferability was to open up financing to much smaller projects than would traditionally be financed by tax equity. That said, I think the first projects we saw were projects that would be financed by tax equity, and it was tax equity investors buying the credits. But now the market is just really exploding. We're seeing small projects getting financed. We're seeing portfolios getting financed. We're seeing portfolios of, wind, solar. We're seeing solar plus storage, all kinds of projects from, the very small like C&I and biogas type projects to very large wind farms, solar plus storage. We're even seeing some nuclear, seeing some RNG. But it's incredible how much the market has grown since the regulations came out in June.
That's amazing. And so the simplest transaction is a vanilla, a clean energy project developer is selling credits to one discrete buyers. What are you seeing in terms of, are there other interesting structures that are coming to light with transferability?
Yeah, I mean, I think the first deals we saw were probably existing, wind tax equity selling off some credits from the last few years, their PTC periods. Then we started to see portfolio deals with people bundling up existing wind farms, selling the tax credits from them. And then we started to see the market, move into greenfield projects, seeing, ITC, new builds for solar, new builds for wind, storage, biogas. I think, there's basically everything is bespoke right now. We're seeing the plain vanilla standalone deals, and I would say every single traditional tax equity deal I'm doing right now has a transferability component to it. It's just become such an important part of the market that it's a feature of every transaction I'm working on right now.
And you mentioned also working on bridge loans against commitments of tax credit transfers. What kind of terms are you seeing on bridge loans?
Yeah, so I think we've seen lenders that traditionally offered tax equity bridge loans step into the transferability bridge market. Seeing relatively similar terms, similar advance rates. If there's a purchaser that's already signed a tax credit transfer agreement, seeing advances in the high 90s, low 90s, low to mid 90s. If there's no tax credit purchaser signed up, seeing much lower advance rates, 75 and below. But for the most part, the lenders that have been doing the tax equity bridges have been willing to jump into the transfer bridge market. It was a steep learning curve for them. They had to get used to the fact that the money was coming in later than it does with tax equity, that the payment structure looked a little bit different, that there's different risks, that different structures may be necessary, but we're really seeing that debt market pick up.
And as tax equity partnerships sell credits out of the partnership, what kind of pricing or how does pricing differ on those deals versus a standalone deal? Is it a smaller discount?
It really depends. And what I'm seeing, the trends I'm seeing are more, 2023 credits are trading much higher than, 2025, 2026 credits. 2024 credits a little bit higher than the future credits as well. I don't know that the structure is driving the pricing so much as the timing of the credits. I think also the technology, wind, solar, and even storage are going to trade a little bit higher than, things like biogas that people are not familiar with the risks. I think wind is trading a little bit higher. PTC is trading a little bit higher than ITC. But I think, I think it'll be very interesting to see once we get into the beginning of next year and, 2023 tax liability has firmed up for a lot of companies. I think we're going to start to see prices go up.
That's very interesting. And as you're negotiating tax credit transfer agreements between buyer and seller, what's come up in negotiations that surprised you the most?
The thing that surprised me the most was a lot of sellers really trying to limit the amount of due diligence that buyers are able to do. Basically saying you're either getting a guarantee or you're getting a tax credit insurance policy, and you need to take our word for it. We're giving you representation. The initial entrants into the market were the traditional tax equity investors, and they were looking to do the same level of diligence that they would do on a tax equity transaction, to confirm qualification for the credit. I've seen some of the newer entrants, some of the corporates, those that haven't done tax equity before, relying more on counsel and doing a little bit less diligence, but still wanting to kick the tires and make sure that the project qualifies. I mean, they're looking for tax credits, not an insurance payout. So, I was a little surprised by that.
Yeah, for sure. And in terms of, I guess, what type of sellers have the leverage to really say there's limits on what due diligence you can do? Is that mainly the tax equity partnerships or the large banks who are putting those limits in place?
The smaller developers that just, want to sell their tax credits and think that they've bought this insurance policy and that's going to make everything okay. And I think it has an impact on pricing. You're if you're not getting to kick the tires as much, you're not going to pay as much. So, it's kind of a supply and demand aspect to it, that if what you're offering doesn't have the same protections as what someone else is offering, that, someone's not going to pay as much for it. So I think it's just kind of the market's going to take care of those sellers that don't want diligence being done, and they're going to get less for their tax credits than the sellers that are allowing buyers to do full diligence.
Yep. And what specific limits are they putting on the diligence? Are they saying you can't dig into the cost segregation analysis, or are there specific areas that they want to curb diligence in?
Yeah, here's a cost seg report. You got an insurance policy. You got to trust us that it started construction. You got to trust us that, the project is actually there and up and running. We've told you it's in service. You don't need to look at an IE report. Why do you care if it's on a super fun site? If it is, then we get an energy community bonus. You can't look at environmental reports. Um, so, it's really limiting kind of all of those third-party deliverables that tax equity was used to looking at. I think we're seeing, especially, sophisticated tax counsel saying, well, you still have issues of tax ownership. We want to look at all of your O&M agreement, your off takes, any revenue contracts to make sure that ownership of the project isn't shifting to someone else. And, sellers are coming back and saying, well, you don't need to look at an O&M agreement, it's ITC. Why do you care if the project operates? I guess you do during the recapture period too. So, there's those considerations as well. But we've definitely seen in the ITC context, sellers try and say, well, you can look at it up to placed in service, but you don't need to be concerned after that. We got you a recapture policy. And that's just not been acceptable to a lot of buyers.
Right. I mean, that's certainly been our experience. We've counseled buyers that it's important to do a fulsome due diligence process and really understand what you're buying. I think that there is some art in really making sure that this doesn't become just another tax equity transaction where there's,
Yeah,
full belt and suspenders diligence on every single little item, but certainly a proper diligence we think is important.
absolutely. Yeah, and seeing, some sellers try and limit, the ability to get a tax opinion or what that tax opinion can cover. But generally, the more sophisticated buyers are looking for an opinion or a memo of counsel, confirming that the project really qualifies for tax credit in the full amount.
One other interesting point that you had made is that audit rights and control of audit was one of the biggest negotiation points on the tax credit transfer agreement. Can you say more about what you're seeing there?
Yeah, I mean, audit rights has become a really big sticking point on a lot of these deals. The issue being that the regulations make clear that the audit can and will occur the buyer. In the seller, generally, these tend to be relatively buyer-friendly agreements. Seller has a lot of indemnities to the buyer. Where the seller has an indemnity, they're going to want some level of control or participation in an audit, But you have these corporates that aren't used to doing tax equity, and the thought of someone meddling in their audit is just completely foreign to them. And even the tax equity investors, I mean, they're buying these credits through their bank entities, and they can't have somebody else participating in an audit at the bank entity level. So it's been a lot of negotiation on what kinds of rights sellers get where they do have an indemnity. Where the buyer is clearly being protective of their audit process and, should be.
And where would you say, the 50th percentile is netting out in terms of audit rights?
Similar to, where tax equity is, if the seller has an indemnity obligation, they have notice and participation rights, but ultimately buyer is going to control any audit at the buyer level. I think, with respect to seller audits, we've seen a little bit more give. Some sellers willing to give buyers a little bit more participation rights, but I think generally where the market is settled is, you control an audit at your own level. If there are indemnity rights, we'll let you be involved. We'll let you have, notice, participation, maybe consent over an audit that's going to, result in an actual indemnity obligation.
And flipping over to other structures that you've seen, we've heard a lot of talk of structures within transfers to enable a basis step up in the case of an investment tax credit. So, for example, an affiliate sale of a project company to a JV. Have you seen this happening in practice?
In terms of the step up partnerships, I think that this is going to be the key to unlocking the market. I think that everyone doing ITC deals is looking for a way to do a step up partnership to get more value from the tax credit. Initially people were referring to these as, accommodation parties, but I think to me it's more of a cash equity transaction. It's not someone who's it's not tax equity. The investors coming in, they're putting money in exchange for getting, a return in cash back. They're looking for like credit card like returns on this. There was this initially people were looking at these kind of step up partnerships as, well, these need to look like tax equity. These need to satisfy the revenue procedure. We need to have a pre-tax profit. And to me, it's different. This is more like a cash equity transaction where you have someone putting cash in and wanting a cash return. Sure, a large portion of that return is coming very early in the partnership because the partnership's selling tax credits. So that money's coming in sooner. I do think there needs to be some variability, and they need to have, some skin in the partnership game, some entrepreneurial risk, upside, downside. So they're getting some of their return from the actual operations of the partnership other than selling tax credits. But I think there was initially all this hand-wringing over making these interests look like tax equity when they're not tax equity. They're more like cash equity, which no one ever had these concerns about structure and cash equity. So I think, in terms of what percentage do these, cash equity accommodation parties, whatever we're calling them, need to have, I think initially people kind of said 20%, because that's kind of, what we think of as a meaningful stake in the partnership. And I think we'll start there. No one wants to be the guinea pig. So I think the first deals are going to get done at 20 or higher. The issue is if you're stepping up the basis of a tax credit, there needs to be a robust appraisal supporting that fair market value. So, the partner interest to me is a little bit more of a red herring. While they do need to be respected as a partner, and I'm not, writing that off or being flip about, not making sure that they're a true partner in the partnership, I think we're losing sight of the bigger issue, and that's, can we support the step up? Is the step up too much? Is there an appraisal behind it? Those kinds of things that we always have to look at. Definitely not saying that we don't need to make sure the partner's a real partner. I'm absolutely saying that. But,
right.
But yeah, I think we're kind of losing sight of the bigger issue, and that's we still need to be able to support the step up.
For sure. Yeah, two separate issues. One is to ensure that the IRS respects the partnership as a true third-party transaction, and the second is how big is too big on the level of step up. And I think that's an ongoing question. The IRS didn't provide clear guidance on a clear line on what's acceptable in terms of step up level. So I think that'll be very interesting to see.
Yeah.
Are you still seeing tax credit transfers with step ups above 20-30%?
Not really. I think, we're seeing the traditional tax equity want to cap it at 15, maybe 20. Newer entrants into the market, if they're not represented by sophisticated tax counsel, can be convinced to go higher. I think the insurance, some of the insurance markets are more conservative than others. Some will insure step ups over 20, others will not. I think a lot of people view that step up over 20 is almost like an insurance arbitrage. Like either we're going to get our tax credits or we're going to get our insurance.
Right, right. And are you seeing any structures emerge to mitigate the risk to the buyers? So, for example, if you have a partnership own a project company, that can help mitigate the risk of recapture if there's an upstream change in control.
Absolutely. I think in the ITC space, we're seeing a lot of these internal partnerships. These are not being done for step ups. They're being done to mitigate recapture risk. It almost creates like a synthetic tax equity partnership where you have your, Class A interest that's getting, tax benefits, or Class B interest that's getting more cash. The lenders, synthetic Class E member can then pledge that interest to the lender to mimic the collateral structure in traditional tax equity that they would have with back leverage. I think if you can get that in place, lenders are getting comfortable. The deals though that, already placed in service where they didn't have the foresight to put something like that in place, I think the lenders are saying, too bad, we get asset level security. We're not going to forbear during the recapture period unless we have access to, that sponsor level interest as collateral.
And flipping back to the tax credit transfer agreement, what sort of limits of liability are you seeing? Are buyers asking for liability coverage, well in excess of the credit amount?
Yes, I literally just had 2 calls about this today. One with a lender, one with a purchaser of what's market on, sizing of indemnities and tax credit transfer deals. And I think if you're a purchaser, you're going to argue that market is the face value of the tax credit and it should be uncapped. If you're the seller, you're going to say, no, why should I pay you the face value of the tax credits? I should only be out for my purchase price. I think we're seeing, truly market, I think we're seeing settle somewhere between those two positions. I think we're seeing purchasers get comfortable if their indemnity amount is sized to the actual value of the tax credits, the dollar amount of the tax credits, then they're willing to accept some kind of a limit on liability that's purchase price plus 20% or something. Because it's very rare to have a wholesale disallowance of tax credits.
Right.
Usually what you're looking at is either the basis step up, or maybe you had one piece of property that you claimed small cost that you claimed ITC on that you shouldn't have, in the cost egg or something like that. It's, just very rare in a situation like this for the IRS to be able to say, no, you shouldn't have gotten the ITC at all.
Right.
I think for that reason, we're seeing purchasers accept some kind of a cap as long as they're getting the indemnity and the amount of the credit. And I think, it also goes to how's your insurance policy size. We didn't talk about this, but I think, all of these deals I'm either seeing done with insurance or a very, very strong, very creditworthy parent guarantee.
Mm-hmm.
And I think, to a seller that has insurance, if their tax credit insurance policy is sized to the face value of the tax credits, then they're fine with their indemnity looking like that, because their agreement's going to say the buyer has to go against the insurance policy before they can seek recourse against the seller.
That's fascinating. And I guess flipping to that question, are you seeing buyers get comfortable with, if a seller says there's insurance, I'm not providing a guarantee, are buyers comfortable with that arrangement?
Yeah, I've seen a number of deals done on insurance only with a very small, very limited parent guarantee. I think, if you've got insurance, really what you're looking at is retention is probably, the uncovered amount, depending on whether contest costs are covered or not. That may count towards the retention. So I think you can kind of quantify what's not covered by the policy and see how comfortable you can get with or without a guarantee. But I've definitely seen deals done insurance only with the seller pushing back on a guarantee or pushing back on a creditworthy parent giving a guarantee.
That's fascinating. It's great to talk to you about this because I know you see so many deals in the market that it's always interesting to see what each party is willing to accept, because it's really a negotiation at the end of the day between
the
buyer
and I would
to
say no guarantee is the exception rather than the rule, and it certainly is going to have an impact on pricing. I mean,
For
all
sure.
of these levers are levers that you can pull economically. And if you're willing to go without a guarantee, you can maybe get a better deal on pricing. If you're insisting on a guarantee, then maybe the seller's not going to be is willing to work with you on pricing and on some other things. I think, the scope of the indemnity, whether it's just breaches, bad acts type things, or if it's more comprehensive, it's any loss disallowance recapture. I think that all goes into the calculus and the economic terms, and all these deals are bespoke and everyone's negotiating what they want out of them.
Right. We've certainly seen some buyers express they want the indemnity from the seller just as a way to
Yeah,
prevent any moral hazard, right? Just to make sure that the seller doesn't do anything that might trigger a recapture. Because at the end of the day, nobody wants to deal with having to get claims from an insurance policy if they can.
right. Yeah,
Um,
I think that's consistent with what we've seen as well.
for sure. Why don't we flip to bonus credits? Because there's still some outstanding guidance we're waiting for on domestic content. But what are you seeing in energy community, domestic content, and LMI?
Yeah, so in energy community, I'm seeing, not really seeing any issues with purchasing credits from projects that qualify on statistical area or on there being a closed coal fired generating plant or closed mine. A little bit more difficult to get a brownfield financed. I think the reason for that is, the determination has to be made by an environmental lawyer. They're not tax lawyers, they're not used to writing opinions. So it's been very hard to get kind of the level of support and the documentation that tax credit investors expect when you're talking about a brownfield. So, I'm not saying it can't be done. I think there probably have been a few, but it's been very difficult to get brownfield finance. But the other two, it's a pretty easy thing to diligence. You look at the address, you see if it's on the appendix, and here we are. I mean, you have to make sure the test year works, in terms of whether it's placed in service or every year during the credit period for PTC, or if you fit into the beginning of construction safe harbor there. But I think that's probably, the more difficult qualification piece than, the underlying qualification itself. I've not seen a lot of domestic content financed. I know two deals, they had insurance, but for the most part, sellers are finding that, right now the market is not willing to finance domestic content. The reason for that being that it's just impossible to get manufacturers to disclose their direct and labor costs. Um,
Are the deals you're seeing on domestic content wind repowers or are they traditional solar installations?
uh, so everyone's putting, kind of this wait and see approach on domestic content. If we get better guidance or if we get manufacturers to disclose costs, then we're going to include the domestic content bonus. The ones I know that actually, included it in sizing were solar.
Fascinating. Awesome. And then last one on the bonus is LMI. What are you seeing on LMI credits?
So the portal just opened last week. So, everyone's scrambling to get their applications in, although you don't have to scramble because it's not first in, first out as long as you meet the deadline. They all get considered at the same time, based on the, weighting criteria. I've seen kind of the same as domestic content. If we get an allocation, if all these things are true, then, we'll finance the credit. I think, people are a little bit more hesitant until the portal opened. I think they were worried that it wouldn't open and that we wouldn't have awards and all of these things. But I think now, the DOE and Treasury have kind of been doing a roadshow of webinars. So everyone's gotten a little bit more comfortable with how you apply and how you qualify. So I've been seeing more LMI elements added to these deals.
So looking forward, we know that there's a lot of demand for solar, wind, and battery storage tax credits. What are you seeing for other technologies? Are you seeing buyers willing to purchase credits from other technologies?
I'm definitely seeing pricing lower from those. Certainly seeing a lot of sellers going to market with other tax credits. I think probably the next biggest category would be biogas, RNG. I think, there's going to be a lot of those. There's a few projects that came online in 2023. I think we'll see more 2024. I think anytime a potential seller comes to me with those types of credits, and says I can get 96 cents a credit, so, well, you're not selling 2023 wind. Um, you probably can't. You need to do your economic projections, assuming a much lower price per credit, and make sure that this is still economic for you at a lower price, and then anything above that's going to be gravy. I think we've heard of some 45U nuclear credits coming out, maybe some other nuclear facilities selling credits with tech neutral um, credits. So it'll be interesting to see what those trade at, because I think there's a lot of considerations there with, public perception around nuclear, and, are investors going to be willing to buy those credits and be associated with those technologies? It'll be interesting to see what the market will bear there. It may be a great way for companies to, get a bargain on tax credits. But I think as we start to see the newer technologies flood the market with lower pricing, it'll be interesting to see if those impact the other end of the market, the credits that people are comfortable with, the technologies that investors are comfortable financing.
I think that's right. There's a lot of expectation among developers that pricing will go up. There'll be a smaller discount as the market matures. But we definitely are wondering if there's a flood of credits from many different technologies all competing for the same tax credit buyer dollars. Will that actually provide some downward pressure on pricing over time?
Yeah, I think it's going to be really interesting to track.
Well, thanks for coming on the show today, Hillary. It's been great to have you. Great to see you as always.
Yeah, this was great. Great chatting.
Talk to you soon.